Welcome to vTalkInsight, Market Drivers Daily for January 6th, 2026. Venezuela's political shock, an accelerating AI, Capex cycle, and a hotter growth narrative are all hitting markets at once, reshaping how investors think about risk, returns, and diversification. The sudden collapse of Venezuela's leadership and the capture of Nicolas Maduro have turned a long-running tail risk into a live test case for how the United States now exercises power in its own hemisphere. Washington is openly reviving a Monroe Doctrine-style stance, aiming to curb Chinese, Russian, and Iranian influence, secure oil interests, and clamp down on drug trafficking networks whose financial scale rivals large corporations. That reinforces a message we have been highlighting in recent days. Geopolitics is no longer background noise for portfolios. It is a structural input. On paper, Venezuela holds the world's largest oil reserves, but years of mismanagement, sanctions, and partial blockades have left production stuck around a fraction of its historical peak and currently under 1% of global output. Infrastructure is degraded, storage tanks are full, and the state oil company has asked producers to slow output, while estimates suggest it could take tens of billions of dollars and up to a decade to restore capacity anywhere near prior highs. That is why, despite dramatic headlines, most assessments see very limited near-term relief to global supply for Venezuela, with any meaningful volume uplift pushed well beyond the current U.S. presidential term and possibly into the next decade. Oil prices have reacted, but not dramatically. Crude has bounced, yet broader commentary still describes the market as oversupplied, with some expecting Brent to test the $40 to $50 range rather than sustain a geopolitical spike. Energy equities, by contrast, have moved more sharply, with U.S. majors such as Chevron, Exxon, and ConocoPhillips, along with oil service names and Gulf Coast refiners, rallying on the prospect of future access to Venezuelan barrels and heavy crude for complex refineries. At the same time, U.S. shale producers have lagged or sold off as markets factor in a potential longer-term supply overhang, even though almost all scenarios agree that Venezuelan volumes cannot ramp quickly. Beyond energy, the geopolitical tremor is visible in classic hedges. Gold and silver have jumped. Safe haven currencies such as the U.S. dollar and Japanese yen are stronger, and defense stocks in Europe and the U.S. are outperforming on expectations of sustained demand. Venezuelan dollar bonds have multiplied in price from distress levels since sanctions were eased, and hedge funds are actively exploring opportunities in non-sanctioned sectors. Yet assets still trade with heavy political and legal risk premia. Regional neighbors are cautious about U.S. interventionism, and there is open discussion that Cuba could become a future focal point, adding another layer of uncertainty for Latin American sovereign spreads. Investors are also being reminded that Venezuela is only one piece of a wider energy risk matrix that includes a high stated probability of further Israeli strikes on Iran, potential U.S. participation, and tighter sanctions on both Iran and Russia. U.S. policy is leaning heavily on energy sanctions as a foreign policy tool, while China has preemptively stockpiled Venezuelan and Iranian heavy crude and deepened joint ventures with Middle Eastern producers to protect its own security of supply. OPEC and OPEC Plus still have the ability to calibrate both crude and refined product flows, which could cushion some shocks, but the persistent use of energy as a geopolitical lever argues for a higher and more volatile risk premium over time. Pulling this together, the cross-asset message is nuanced. Broad equity indices remain resilient and implied volatility is subdued, yet pockets of the market, from energy and defense to gold and Venezuelan credit, are already repricing geopolitical risk. For portfolios, the key questions are how much geopolitical uncertainty is embedded in current valuations, whether markets are underestimating the chance of wider disruption, and how to balance exposures between beneficiaries of higher defense and commodity spending and sectors vulnerable to deglobalization and trade frictions. Those same tensions are intersecting with another dominant narrative, the AI and technology build-out, where demand for power, metals, and secure infrastructure is rising just as geopolitical fault lines deepen. Technology remains the primary engine of global equity performance, and within that, artificial intelligence continues to set the tone, even as the market becomes more discriminating about where sustainable profits will land. We are seeing a powerful tech-led rally across Asia, Europe, and the U.S., driven less by generic AI enthusiasm and more by concrete earnings upgrades for key semiconductor and hardware names at the center of the AI capital expenditure cycle. Core AI infrastructure providers look especially pivotal in this phase. NVIDIA, for example, is signaling revenue growth that some expect to exceed 65%, with several commentators arguing current street forecasts may still be 15 to 20% too low. The company has highlighted a new Vera Rubin platform that cuts inference costs by an order of magnitude versus the prior generation, expanded its push into physical AI areas such as robotics and autonomous driving, and is open sourcing models to accelerate adoption. Backward compatibility across chip generations allows customers to upgrade quickly, reinforcing the idea that whatever happens with individual AI applications, demand for the underlying compute and infrastructure may prove more durable. Asian chipmakers are a major visible beneficiary of this backdrop. Semiconductor giants like TSMC and Samsung are helping drive regional indices to new highs after high-profile analyst upgrades, while European equipment makers such as ASML ride the same wave. The AI theme is also underpinning bullish expectations that the Nasdaq could outperform by more than 10% annually over the next few years, led by AI-first companies and the broader hardware complex. Importantly, a large share of the roughly $1 trillion in projected AI infrastructure investment through 2028 is expected to be financed by high-grade issuers, which supports the idea of an extended, credit-friendly cycle rather than a fragile leverage bubble. Beneath the headline strength, however, there are clear signs of stress and differentiation, particularly in software and more speculative AI names. OpenAI's ability to secure around $100 billion of fresh capital by March is viewed as a litmus test for the broader funding environment. Success could extend the current boom, while disappointment might cool enthusiasm for incremental and profitable AI plays. Semiconductor ETFs have massively outperformed software peers, and there is a persistent narrative that AI is eroding traditional software business models, reinforced by downgrades in well-known names and the collapse of businesses exposed to legacy service models, such as call centers. On the real economy side, companies are increasingly using AI to manage hiring and workflows, contributing to slower recruitment, but not yet a wave of layoffs, which points to a sideways labor market rather than an immediate employment shock. Investors are watching closely to see whether enterprise AI budgets move from experimental pilots to core operating spend, which would help validate the earnings power implied by current valuations for infrastructure providers. Upcoming catalysts include NVIDIA's high-profile presentations at industry events, progress on OpenAI's fundraising, and signs that AI-related power demand is feeding through to sustained investment in grids, renewables, and industrial automation, which ties directly into the broader growth story. The macro narrative coalescing in markets is increasingly one of running the economy hot. Solid and potentially accelerating growth, somewhat sticky inflation, and a belief that corporate earnings can compound even with policy rates staying higher than in the last cycle. Some high-profile strategists now project the S&P 500 reaching around 7,700 by year-end and 10,000 by the end of the decade, underpinned by expectations that earnings could climb toward $500 per share as productivity improves. A key pillar of this optimism is productivity, with forecasts for U.S. trend growth in output per worker rising from roughly 2 to around 3% annually as AI adoption broadens into sectors like healthcare, financial services, logistics, and manufacturing from 2026 onward. Fiscal policy is also in play, with retroactive tax refunds of $1,000 to $2,000 per household expected to provide a near-term consumption boost, while defense spending is rising and additional budget requests are anticipated after recent military actions. Globally, equity leadership is broadening beyond U.S. megacap tech into areas such as European renewables, grid cables, and defense, as well as Korean memory stocks and Latin American markets that are leveraged to industrial and metals demand. The tension for multi-asset portfolios is that this constructive growth backdrop collides with very optimistic pricing for both policy and risk assets. If U.S. GDP were to hold above 4% with inflation in the upper 2% range, that would challenge consensus expectations for aggressive rate cuts and could instead push 10-year Treasury yield higher again in 2026, especially as the Treasury funds rising issuance and AI-related infrastructure draws on savings. At the same time, even as analysts foresee roughly 15% profit growth for the S&P this year, there is open acknowledgement that an election year, potential changes in Federal Reserve leadership, and geopolitical surprises could still trigger a 10 to 15% equity correction from elevated starting valuations. Offsetting the bullish narrative are pockets of strain that argue for humility about the trajectory of growth, including pressure on small businesses facing cautious, price-sensitive consumers, and early signs that AI adoption may weigh on hiring intentions. The globalization trends, from U.S.-China trade renegotiations to possible friction with Europe over energy and tariffs, and the unresolved underinvestment in traditional energy infrastructure all add to the risk that the current expansion prove bumpier than headline indices suggest. For investors, the watch list runs from inflation and productivity data to fiscal decisions, term premium behavior in long-dated bonds, and the durability of earnings revisions. These will determine whether the run-at-hot thesis can persist without destabilizing either rates or risk assets. To sum up, Venezuela has crystallized geopolitics as a core market driver, but for now the direct oil supply impact looks limited while select assets repriced a higher risk premium. AI remains the strongest structural theme, with infrastructure and hardware at the center of both the tech rally and the broader productivity narrative, even as more speculative names face tougher scrutiny. And the emerging run-at-hot growth thesis offers upside for earnings, yet also raises questions about how far rates can really fall and how much geopolitical and policy risk is embedded in today's valuations. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.